Hey, hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst and writer at Cointelegraph. Today is Friday, March 24, and we'll be discussing the impacts of the macroeconomic news and events on the crypto space. But don't worry, I'll explain everything in plain English, no jargons or technical phrases, focused on the cause and effect on the day-to-day crypto trading activity. First of all, thanks for everyone that has been sharing my articles and videos on Twitter and Telegram groups. Thank you very much. For today's show, we start by discussing the basics of money, or how to calculate the total in circulation. Yeah, that's not really obvious for fiat money. So base money refers to the amount of physical money in circulation, such as coins, banknotes, as well as reserves that banks holds at central bank. So it's a very narrow measure. It's the foundation of a country's monetary system, and it's used to create all other forms of money in the economy. M2, on the other hand, is a measure of the money supply that includes not only the base money, but other forms of money that are less liquid, such as saving deposits and money market funds. So, by offering near zero interest rates and reducing financial institutions' reserve requirements, the central banks can effectively expand the M2, the bigger monetary base, to support the economy. That's why the expression print money can be so delicate, as the effective M0, the base monetary base, can remain unchanged even if the broader M2 expands significantly. Regardless to which metric is more relevant to the economy, there's solid evidence linking the monetary supply change to risk asset prices, including cryptocurrencies. I'll show you a chart from a Twitter post that perfectly describes what I'm talking. So this chart, brought by Hogger, shows the US M2 annual percentage change, the green area over here. So there's an increase of 10%, then 25%, and it declines to 10%, and now the M2 in the US has been declining by 2% per year. Notice how the 25% M2 expansion in 2020 precedes the Bitcoin rally. Bitcoin is the orange line here on the left scale, and you can see that the money M2 expanded by 20-25%, and a couple of months later, like 8 months later, the Bitcoin rally initiated from $12,000 all the way to $60,000. Moreover, as the M2 rate went below 12% early 2022, fastly declining, Bitcoin took a downturn below $40,000. It's the orange line here. And that happened just 3 or 4 months after the M2 of the US started to slow down compared to the previous 25% expansion. Okay, so it should be clear by now that more money in circulation tend to cause scarce assets price to jump. And there's no reason cryptos should be immune to that. We all know central banks' only solution to avoid financial crisis is to inject liquidity in the markets, so expanding the money in circulation through numerous strategies. It's a matter of time, which could be 8 weeks or 18 months, but it's coming our way. The impact on risk assets is usually delayed by a couple of months, but there's nothing stopping investors to anticipate the move. If you remember the chart, the first move, the expansion of the monetary base to 25%, took 8 months to impact crypto prices. The decline on the monetary base expansion took less than 4 months. If investors feel that the central banks are cornered, which seems about right, considering so many banks have been rescued recently, then obviously they're gonna try to anticipate the move, monetary-based expansion, the M2 expansion, subsequent rally on scarce assets, including stock markets and cryptocurrencies. Okay, so let's recap why you should follow the global M2 monetary-based data. Number 1, the only solution for governments to avert a larger crisis is expanding the monetary base, the money in circulation. It can happen through lower interest rates, US dollar devaluation, or money printing, effectively increasing the M0, the base money. Number 2, considering you don't know if cryptos are going to anticipate the movement, there's no reason to wait for the M2 chart to move before taking a larger position in cryptos. As for the holders out there, just be patient and avoid using leverage. Now, on to the next topic. This time, we'll be discussing the housing market. We all became aware of how large it was in the 2008 crisis, but it's been 15 years. How relevant or risky it currently is? Well, the residential real estate in the world is estimated at $260 trillion, a third of that coming from China. Even if we consider it solid investment and somewhat a safe haven during crisis, it is very hard to compete when the monetary base expands by 25% in a year. Need an evidence? Well, the US Case-Shiller Home Price Index, peak performers during the COVID crisis, the multi-trillion-dollar packages, was a 21% price increase over year over year for housing market. So it underperformed the money printer by 4%. That shows you how real estate can't beat hyperinflationary periods, especially if they last for over a year. But there's a big difference from 2007-2008 to the current scenario. This time around, delinquency, meaning unpaid mortgages, are far off from being an issue. If the home buyer caught a 2.5 or 4.5 rate during the past 3 years, why the hell would he miss a payment if the current 20-year rates stands at 6%? It just makes no sense. Moreover, latest data from January 2023 show that total mortgage that has been unpaid for 30 days or longer declined by 15% versus the previous year. So delinquency is going down. Sure, that might change if the crisis aggravates, but it doesn't seem to be a big issue for now. So the question the crypto investor should be asking right now regarding the real estate market is what would trigger, let's say, a 5% outflow of the $260 trillion from the real estate to elsewhere. That's a whopping $13 trillion. Just 5% of the housing, real estate, residential market. In comparison, the entire gold market cap, it's smaller than that, 11 or 12 trillion dollars. The entire S&P 500 index, all the companies, the 500 companies, are valued at $36 trillion. So there's just not many doors for scarce assets. Okay, so let's create 2 hypotheses for how this money from real estate should be driven away from this market. The first one is government rent control. It's a way to subsidize inflation, blocking rent price increases. However, the impact on the housing price is always negative when that happens. So that could trigger quickly a 5% outflow from housing markets to other markets, including cryptos. A second hypothesis would be surging mortgage rates. If the money printer is turned back on, debt holders will demand higher returns for fixed income investments. In turn, mortgage rates will go sky high, literally above 15% per year. Who would able to afford a mortgage so expensive like that. That would also create some exodus from the housing market. And we all know cryptocurrencies represent a form of a digital scarce asset. So there's a slight correlation about the investment thesis from real estate markets. I'm not saying that you should tell your parents or your friends to sell their real estate investments and go all in cryptocurrencies. What I'm saying is that in a hyperinflationary environment, like if the monetary base expands by 25-30% 2 consecutive years, those who seek shelter on real estate investments will not be able to keep up with inflation, with the amount of money needed to compensate the larger currency in circulation. So they'll be effectively losing money. Maybe it's little, maybe it's 5% per year or so, but yet they'll be losing money. So a way to protect from that is seeking shelter on alternative assets. It could be some tech companies, especially if they're well positioned to capture the market in a crisis situation, if they have loads of cash in the pocket to buy their own shares if the share price drop, or to buy competitors at a bargain during a crisis. There's thousands of ways that companies can benefit from a crisis or from expanding monetary base. Cryptocurrency is not the only scarce asset in the world. Of course, there are some that has been more consistent in their monetary policy than others, namely Bitcoin, but it's still slightly shifting from a risk thesis, especially related to tech companies, and being interpreted as a commodity, as a digital asset. And this change in the mentality of the investors takes time. I'm not saying that even if 5% outflow happens from the real estate market, like the two hypotheses I gave, that 10% of that money is flowing to crypto. No, it's not like that. I'm just saying that over the span of 2 or 3 years, that money that flows away from real estate, which is a huge investment market, some of that will be flowing to cryptocurrencies. And that's one of the drivers that could be leading Bitcoin and cryptocurrencies above $5 trillion. That's not something insane. We've seen near numbers in the past, I think over $3 trillion for cryptocurrencies. So 5-6 trillion is easily feasible. It could happen over the next 2 or 3 years. So be prepared. Don't wait for the M2, for the money printing to be started to turn on, to then chase the numbers or pay the highest price in the year. Start investing regularly with conscience. Well, that's it for today. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. I'll be airing every Friday, 12 o'clock noon Eastern Time. See you next week.